Welcome to This Explainer. Today, we're diving right into one of the absolute biggest, most mind-boggling financial scandals of the early 2000s. The Italian financial newspaper Il Sole 24 Ore actually called it the mother of betrayed savings in Italy. We are going to unpack the spectacular, devastating collapse of the Cirio Group, which was the seemingly invincible agro-industrial empire built by a man named Sergio Cragnotti.
So, the big question we're tackling today is this. How exactly does a massive, globe-spanning conglomerate, and we're talking about the beloved owner of a major football team here, how do they end up financially ruining thousands of everyday people? How did all that high-level corporate risk just trickle down to the unsuspecting public? Part 1, the rise of the Cirio Empire, and the mastermind behind it all, Sergio Cragnotti.
Okay, let's dive into this timeline. Cragnotti wasn't born into old money, He was this gritty, determined accountant who hustled his way up the global corporate ladder until 1991 when he founded his own holding company. And his strategy? Brilliant but extremely aggressive. He just started buying up iconic Italian brands. By 1993, he scoops up Cirio, which is an absolute cornerstone of the Italian food industry. But his truly unprecedented move comes in 1998. He takes the SS Lazio football club public on the stock exchange. It was the very first Italian team to ever do that. And man, on the surface, this whole thing was just glittering. It looked completely invincible. The Cirio Group was aggressively expanding across Europe, Asia, the Americas. And meanwhile, Lazio was just dominating on the pitch. They took on the prestigious Scudetto in 2000, along with a bunch of other major trophies. You'd see the Cirio logo splashed proudly right across the players' chests, giving the brand this immense, undeniable public visibility. I mean, Cragnotti literally looked like an unstoppable titan of Italian industry. All right, moving on to part 2, the Cirio bond trap. Because, behind that sun-drenched, glamorous facade of the Stadio Olimpico, the financial reality was a completely different story. The foundation was severely unstable, and the cracks were starting to show. Look at this stark contrast. Cragnotti's massive corporate shopping sprees were mostly funded by short-term bank debt. Back in 1994, debt was sitting at a manageable 20% of revenue. Fast forward to 2002, it had skyrocketed to an unbelievable 160% of revenue. To put that into perspective, that's over 1 billion euros, which was literally double the net worth of the entire company. They were essentially borrowing short-term cash to fund these massive long-term dreams. So, to buy himself some time and keep this giant machine running, Cragnotti turns to the market by issuing bonds. Now, just as a quick refresher, when you buy a bond, you're essentially lending your own money to a company. You buy a slice of their debt, and in return, the company promises to hand you your principal back at a specific maturity date, plus they give you regular interest payments along the way. Here's where the trap gets set. To make these specific Cirio bonds incredibly tempting to regular folks, they offered huge interest rates, anywhere between 6% and 8%. That was way, way higher than your standard, safe government bonds. It was a very deliberate, calculated lure designed to pull in ordinary retail investors, people who really weren't used to investing large sums of money, but who implicitly trusted that famous historic Cirio name. Now, what's really interesting and terrifying about this is the sheer number of glaring red flags. These bonds completely bypassed standard public protections. They were issued by foreign shell companies like Cirio Finance Luxembourg. They received absolutely zero official credit rating. There was no informational prospectus approved by the authorities. And honestly, the craziest part, legally, these bonds were meant only for institutional investors like major banks. They were never, ever supposed to be sold directly to you and me. Part 3. The mechanism of failure. This brings us to the devastating turning point. Because despite this massive flood of cash from the public bonds, the internal financial strain just became unsustainable. The clock finally ran out. In November 2002, Cirio failed to repay a 150 million euro bond maturity. It was just one missed payment, right? But here's the catch, a brutal contractual clause called cross-default. And what that means is defaulting on one single specific debt immediately triggers the insolvency of every single other debt the company holds. That one missed payment was absolutely fatal. So what does this all mean? It meant an immediate, catastrophic domino effect. Suddenly, all of Cirio's massive debts were instantly due at the exact same time. Panic completely takes over the market. Bonds are immediately withdrawn, and all payments to investors are just indefinitely suspended. Cragnotti is forced to resign in disgrace. And by October 2003, the Rome Tribunal officially declares the state of insolvency. The
The crack Cirio was now a horrifying reality. Part 4, the disaster for small savers. Because this wasn't just some abstract high-level corporate failure, it was a profound, life-altering human disaster. And this brilliantly, or maybe tragically, illustrates how this happened. How did highly risky bonds meant for financial institutions end up destroying the savings of regular families? Well, look at 1999. A massive 94% of Cirio's debt was held by banks. But by 2002, after all those bond issuances, bank loans dropped to just 28% of the debt, while everyday bondholders now held the vast majority. The banks successfully acted as intermediaries to offload their own institutional risk, pushing all that toxic debt directly onto the unsuspecting public. The resulting collateral damage? 35,000. That's 35,000 small savers who were left holding absolutely worthless pieces of paper. And so many of them bought in without any real transparency, just trusting their local bank managers and the visibility of the Cirio brand. And keep in mind, this hit right around the same time as the Argentina Tango bond default, so this whole era was just a deeply anxious, financially devastating period for everyday savings. The legal and financial aftermath was, well, monumental. Sergio Cragnotti was officially arrested in 2004. Almost 20 years later, in 2021, his conviction for fraudulent bankruptcy was definitively confirmed. Over the course of 2 really long decades, they did eventually recover about 800 million euros for the creditors and bondholders. And sure, that's a significant amount. But the profound structural damage to public trust in the financial system, that was permanent. Which brings us to part 5, how to protect savings today. The whole Cirio nightmare was a massive global wake-up call that completely reshaped modern finance. The European Union actually stepped in to create a really robust regulatory shield, the 2007 mifid directive. This strict legal framework was explicitly designed to stop exactly what happened with Cirio. No more casual, non-transparent predatory sales of highly risky financial products to the general public. Let's see how this builds a safety net for us today. Under MiFID, financial advisors and banks literally have to follow strict legal steps. First, they've got to provide incredibly detailed, transparent information about the product. Second, they must meticulously assess the investor's specific risk profile and financial knowledge. And third, the investment actually has to align with and respect your personal goals. They can no longer legally sell a high-risk corporate bond to, say, a retiree who's just looking for a safe harbor for their money. Which brings us to a final provocative thought to leave you with. The spectacular rise and fall of the Cirio empire teaches us that trust is an incredibly precious but very fragile commodity in finance. So with these new MiFID protections firmly in place, is trust guaranteed? Or in our ever-complex financial world, does your own investor vigilance remain your true final line of defense? It's a vital question we all need to answer when we're managing our savings. Thank you so much for joining me for this explainer.